Hello everyone, welcome back to another video. Today we're going to be talking about asset deals in M&A transactions and 5 common areas of mistakes that business buyers make when going through an asset deal. So just as a quick background, I'm a Canadian investment banker focused on middle market transactions, primarily on the sell side. So I'm going to try to share some of the common tips and tricks that I've seen successful buyers apply when working through asset transactions. And hopefully that will improve your chances and really the stress levels as you go through an asset deal. So just to begin, how do asset deals actually work? Let's understand the difference between a share purchase and an asset purchase. And put simply, in an asset deal, the buyer creates a new purchase co and then buys the business assets of the seller, which in this case would be ABC Business Inc. The selling entity still exists post-closing. So meaning what ends up happening is that they put the cash, the buyer's cash, plus the bank debt into Purchase Co. Purchase Co. then writes a check and acquires all the business assets from ABC Business Inc. And now the purchased assets exist within Purchase Co. and ABC Inc. still exists as an entity. But what that means is that all of the contracts and all the relationships and all the paper agreements that exist between the customers and the suppliers of ABC Business Inc. now have to be moved up into Purchase Co. And that's what makes an asset deal a little bit more complicated, a little bit more work, because you have to change all of those agreements over to the new company and the new business name. Now, on the flip side, the reason why share deals are a little bit more convenient is that similarly, you still incorporate a purchase company. So you put your buyer equity and your buyer bank debt into Purchase Co. But then Purchase Co. buys the shares of ABC Inc. So everything that exists within that corporate entity is now owned by Purchase Co. And then usually what ends up happening is in order to bring the business debt, the bank debt that exists right now in Purchase Co. onto the balance sheet of the operating company, which has just been acquired, Purchase Co. and ABC Business Inc. merge together, amalgamate on the same day of the closing to form one company, which is ABC Business Inc. So Purchase Co. gets amalgamated into ABC Business Inc., and then ultimately that entity continues on. So the contracts don't have to be changed, the bank accounts don't have to be changed. It's a lot simpler. So really from an ease of transaction closing and the work involved, share deals are easier to do than asset deals. But obviously most buyers prefer asset deals because you can carve out liability risks, you can step up the value of the assets and therefore allow for more tax efficient cash flow moving forward for the buyer. But in Canada, where we're based out of, usually the share deal is more common. I would say probably 2/3 of the time it's going to be a share deal because of the capital gains exemption rates that exist here in Canada and that sellers prefer to sell shares. Whereas in the US, it's a little bit more litigious and usually business buyers expect to buy the business assets. So let's actually jump into what are the 5 common areas that when you're going through an asset deal, you should be aware of. And these are common areas that we've seen deals get hung up on or delayed, and business buyers incur additional cost and time to really navigate these situations. And so, in the first part of this video, it's going to be operational items, employees, and customer and suppliers. And then there'll be a part 2 where we'll cover working capital and then banking and the insurance transition as well. Now, as a whole, asset deals usually result in a longer closing process. And the reason being that there's a lot more work involved in transitioning and communicating with all the counterparties associated with that business. So usually what that means is that a business buyer has to be a lot more organized and a lot more on the ball earlier on in the closing process to start initiating some of these processes. But at the same time, the seller is going to resist wanting to start the process too early, meaning you may sign an offer with the seller, but at the end of the day, that seller is not really going to feel confident that you're going to close on that deal until you confirm your bank financing, until you put legal agreements in front of them, until substantial due diligence negotiation has been completed. So there's this balancing act of, you can try to get ahead on these issues, but the seller is going to resist a lot of communication with the counterparties because they don't know if you're going to close the deal. So usually what ends up happening is that a deal may take 90 to 100 days to close, and the first 60 days are due diligence and dealing with the bank and the financials, and none of these 5 areas get addressed until the remaining 30 to 60 days pre-closing. So really what ends up happening is that everything gets compressed within 3 weeks, within 4 weeks. So it's a lot of work and there's a lot of different moving parts. So really the purpose of this video is to try to summarize everything, and hopefully you can kind of take notes and really be on top of it so that you don't drop the ball. But I can tell you that most buyers do. There's going to be something that's going to go awry, and that's just the nature of asset deals. They're just a little bit more complex. So my advice to you as a business buyer, number one is communication. If you really want to get ahead of these issues that are going to come up, it's really important for you to actually have a really good relationship with the seller. And so what I've seen strong buyers do, especially even if it's a share deal or an asset deal, is weekly communication. Setting a time in the calendar where you actually communicate with the seller and you update them on your progress, and you start really pushing these topics around how are we going to transition the banking, how are we going to transition customers, and let the seller react and process the information and slowly come around to the fact that, yeah, there's a lot of work here. And if we don't work hand in hand together, it's going to be a lot harder for you to transition this business. So highly recommend that it's not a one conversation, but it's a continual conversation throughout the closing process and starting to really bring up these topics as you get closer and closer to the finish line. So let's jump into the first area of mistakes, operational items. So the first bullet point is payroll systems. And I can't stress this enough. When you come into a new business and you're trying to really communicate stability to the employees that feel a lot of pressure and uncertainty around the business that is just sold, messing up payroll in the first week is just not acceptable. But I've seen it happen with asset deals. And the reason why is that usually when you transition over, you may have outsourced that payroll, or payroll may be done in-house, but the information for the employees, the tax information, the payroll details, all of that are items that the seller usually would do themselves, and now they have to transition that over to you. But what happens if you close on a Wednesday and payroll's on a Thursday? Are you going to get around to actually learning how payroll gets processed in a day? No, what ends up happening is that there's a mad scramble to try to make it work, and you're really leaning more on the seller. So what my recommendation to you is really getting ahead of that and taking a couple weeks prior to closing, just walking through the payroll process with the seller. And if it's outsourced, getting the information, communicating with the outsourced payroll supplier as well, whether it's ADP or someone else, to really understand how their system works. And then ultimately making sure that when you process payroll with your money, with your bank accounts, because there's going to be different bank accounts than the past bank accounts, you have enough money, and also you are paying out based on the correct and updated compensation levels. So sometimes I've seen mistakes where, the buyer had a document and the hourly rate for the employees in that document is actually dated because there was a raise a month prior to closing. And all of a sudden, the employees look at that and say their pay stub is actually paying them less than before. And asking questions come up and pressure starts to rise. So it's very important that you don't mess up payroll, and you should get ahead of that pre-close. The second one is, don't forget to register for your sales tax. So in Canada, that would be HST, GST, and then as well your payroll tax registration numbers as well. And so there's going to be a lot of things going on. So you could almost define this first bucket as the small things, but ultimately registering for those items when you incorporate the purchase go pre-close, start that ball rolling quickly, because ultimately, whether it's the CRA or the IRS, it's going to take time for you to get those numbers in place and for you to get familiar with how that works. So don't wait until the deal closes. Do that a couple weeks ahead of time. And this is something that you don't really need the seller's involvement in. You're trying to set up your own corporation with your own HST numbers and your payroll tax information. The third one, and this is a big one, is transitioning the vendor accounts. So there are certain accounts that you're going to have to set up new. Because it's a new purchase co, it's a different legal entity, you just create a new account and then start paying through that account. But there are other accounts where you can't set up a new account because it's specific to that business, to those assets, to that real estate, to that address, whatever it is. And so those accounts need to be transitioned. And what that means is you need to have the login details ready on paper and on the day of closing. And so what are some of these vendors? It could be payroll systems, IT and email servers, your website, the business telephone line with Bell, Rogers, AT&T, whoever you use, toll road accounts. So in Canada, it's the 407 ETR. And so those toll roll accounts, you don't set up a new one for the vehicles of that business. It's the existing one as well. There could be utility and property tax portals and where you make those payments. Again, that's not something that you create again. It already exists. All you have to do is transition it over, update the payroll, the payment information, because now you're going to pay out of a different account. So it's a different direct deposit information. And that transition may also take time if you have to mail in the updated banking details. So really what you want to do is you want to hit the ground running on this within the first week. And you don't want the seller to have that information and wait for the seller to provide it to you after the deal closes. Because funny enough, we're just going through a recent transaction right now where unfortunately there's a bit of tension and there's so much going on that the seller didn't put down the information for certain items like the business telephone number. And now conflict has arisen, and now the seller's holding out on giving that information to the buyer. So you don't want to be in that situation where there are these small little nitpicky things. Put that on a piece of paper, have that at the ready on day one so that you can start transitioning these accounts that you have to. And a good way to start is actually just to look at the supplier list. So go on the QuickBooks or the accounting system and just pull out all the vendors that the business has paid in the last year and go through each one and just highlight which one do I have to set up a new account for and which one do I need the login details because I can't transition that account. And for those login details, then sit down with the seller and get that on paper on closing. Okay, now continuing over, another one is the business name and how do you transfer the name? So just before I dive into that, just understanding the concept. So in an asset deal, say for example, Finance Kid is the business that we're buying. So Finance Kid Inc. is the business name. You don't buy the business name and then change it to the same name because what you're trying to do is separate the old company from the new company to carve out those liabilities. That's part of the reason why you do an asset deal. You want to kind of make sure that you're not buying the past liabilities associated with that company. And those past liabilities are associated with that specific corporation with that specific business name, meaning Finance Kid Inc. So what you end up doing is you may buy Finance Kid as the business, but you would set it up as Finance Kid Corp instead of Inc. Okay? And so what that means is when you change the name, all of those documents need to be changed as well and updated to reflect the new company name. But what happens with the old name, Finance Kid Inc.? Well, in the purchase and sale agreement, there's going to be terminology around transitioning that name and then the seller having to change the name and remove that name and not be able to use it anymore because you wouldn't want them to use it anymore. But my piece of advice to you, and I've seen it go both ways. I've seen transactions where they close and the seller changes the name within the first couple of days, and I've seen transactions close and then the name is changed a couple months later. My preference, and I would say from the buyer's point of view, is it's better that you actually don't change the name right away. Because what the challenge is, say for example, there are checks in the mail associated with the accounts receivable of that business. So you close on a Wednesday, and a customer just wrote a check on the Tuesday, the day before, and wrote a check to Finance Kid Inc. with the payment amount and the payment information. And that check lands on your desk on Thursday after you close the business. Now, when you take that check to the bank account, you can't, again, if the name is changed, you can't cash it in because you're Finance Kid Corp. And then the seller who's just changed the name away from Finance Kid Inc. can't cash it in as well. So you have to go back to the customer and ask them to reissue the check under the new name because the Finance Kid Inc. has been terminated and changed. So it's better to just leave it there for a couple months. And so the transitionary period that I recommend is probably about 90 to 120 days because that's enough time to really flush out all the accounts receivable that are floating around there and the potential need for the old name for you to cash those checks. And so this mostly relates to AR because, again, that's the number one thing you want to focus on when you're collecting. And we'll talk about that later on in the video. That AR transition is one of the biggest challenges in doing an asset deal. But what ends up happening is when there's an old check, say for example, the Finance Kid Inc. that comes in the mail, you want to work hand in hand with the seller for the seller to cash that and then pass those funds over to you, assuming that those funds are rightfully yours after the fact. So from a business name point of view, don't change it right away. Give it a couple months. Now, here's another one. And the landlord is an interesting one. So, landlords can derail deals, and that's both in share deals and in asset deals. But the thing with an asset deal is that now you really open up more of a discussion with the landlord around updating the lease to reflect the new name. Now, you can make an amendment to the existing lease, But usually landlords are not only banking on the legal document that exists, but also the guarantor and the person operating that business. Because from their point of view, I've given you use of this space. Are you going to pay the rent for the next 5 years? Because I probably, as a landlord, have a mortgage on that property. And I'm not only banking on you paying next month's rent, but the rent for the next 5 years. So what ends up happening is that landlords actually dig in further into the buyer and really try to understand the risk level of the buyer. So how do you actually approach this? Well, the first thing is you always go through the seller on this one because they have an existing relationship. So the seller would pick up the phone and let the landlord know, a couple weeks prior to closing. I say with this one, landlords can take their time and really drag their feet. So I would give this actually a couple weeks. Best case, a month. Worst case, at least 2 weeks. But if you're doing this the week of closing, good luck getting a response from the landlord because they're really going to take their time and try to leverage this situation to their benefit as well. So really starting that at least a month prior and letting the seller pick up the phone and initiate the conversation. And what will end up happening is the landlord will say, great, you're selling your business. We're going to need to do some background diligence on the buyer. And so what you're going to come to expect, and this is what I'm telling you right now, as a buyer, is they're going to ask you for a personal net worth statement, and they're going to really dig into your financial ability because they want to make sure that you can pay the rent for the next couple of years, whatever the term of the lease is. And then there are certain situations where leases have personal guarantees. And so they may not only expect you as the tenant, the new tenant, to sign a personal guarantee, which don't be surprised if that comes up, but then as well, if they don't feel comfortable, maybe you're a first-time business buyer, maybe you're a leveraged buyer, maybe you don't have the depth of net worth and you don't want to put your investors' personal guarantees up, so you only give your personal guarantee, that landlord may say, you know what, we're not comfortable with just that PG. We actually need the seller to co-sign onto the PG and stay on for, a transitionary period so that we can get comfortable with your operating ability. So what that means is that, the seller who wants to walk away from this deal and obviously sell the business and move on with their life, now the request is going to come up that they're going to have to stay on as a personal guarantee. Hold on a second. What does that mean? So that's going to create more conflict. And so you have to navigate that. Unfortunately, at the end of the day, the bad guy is actually the landlord. It's not you as the buyer, but the seller's going to have to react to that, process that, talk to their team, to their advisors, to their banker, and realize that at the end of the day, if the landlord chooses to take that line of questioning and that approach to mitigating their risk, then if they wanted to get this deal done, they're going to have to give that guarantee anyways. And so it's more just an element of time for them to come around to those types of topics. And then the last point around the landlord, and I've seen this a couple times, so don't be surprised if it comes around, is, say for example, the lease is, 1 or 2 years away from a renewal. You have an extension built into the lease, so there's no worry about losing the property, but you're going to have to renew at a higher level. Probably current market rents are much higher than what the lease is, and the business is paying for as with that current lease. And so what the landlord's going to do is say, you know what, happy to kind of take you on, but I really want to make sure that you're here for a long time. Let's negotiate the extension now. And they're going to push that and hold out on really assigning the lease and giving you a new lease agreement for the new company until you actually extend terms and maybe tack on either an increase to the current rent for the remaining 2 years or just extend it for the plain 5 to 10 years and just do the renewal now instead of a year or two down the road. And that way it solidifies the landlord's position and they essentially get their lump of flesh in turn for, signing on to the new deal. So they can be, I would say, rude and stern in that way. So don't be surprised if the landlord is actually the black swan in the deal closing situation. So again, this one started early. At least I would say a month is a really good time for everything so you're not really feeling pressure that 1 or 2 weeks away and you have to kick out and delay the deal. And then not only does the seller have to now come around to new terms, but then the deal is delayed and their gratification is delayed. So better to start this process early and maybe even talk to the seller again in those weekly meetings to say, hey, listen, I've heard in the past that landlords can be a bit painful to deal with. So I don't know what's going to come out, but here are some things that I'm just going to keep you updated with regards to the process. So really kind of make them the bad guy from the very beginning and make the seller feel like it's not you proposing these terms, it's obviously the landlord. And then the last bullet point is around capitalization and the funding cycle. So in asset deals, and we'll talk about the working capital transition in a later video, but when it comes to just buying a business and then transitioning the AR collection and the accounts payable payments and all that over to the new buyer, there's always going to be a bit of a delay. Whether it's the new customers getting used to the new bank account details and wiring payments to old bank accounts rather than new bank accounts, or just picking up the phone and actually explaining the deal, and then that just creates a week delay or 2 week delay on that customer actually writing the check to pay the accounts receivable that you're owed. At the end of the day, we see that it's not a permanent, but probably for 1 or 2 months, AR collection periods lengthened by probably 5 to 10 days because of just getting used to the new situation. So from your point of view as a buyer, I always call buyers a week after closing, they're always stressed with asset deals, especially around collection and making sure that enough money's coming in so they can cover payroll the next week and really start getting comfortable with the deal. So my recommendation, if you really want to reduce your stress, is really just making sure either you have an operating line as of day one ready that you can draw on, or have excess cash on the balance sheet to fund that extension in collection terms. Just recognize that it is most likely going to happen because of everything that's going on and the changes associated with the asset deal. So let's go into the second topic, employees. And this is a big one. Now, I'm going to just kind of preface it by saying I would say 80% of what we're going to talk about in these next couple of slides are relevant for both US and Canadian buyers. There's about 20%, which is associated more with Canadian laws and employment laws around severance, because up here in Canada, every state has severance. So whereas in the US, there are certain states where you don't have to pay severance. So a little bit different. But at least the concepts are very relevant and they should be top of mind, because with asset deals, employees are another big wild card that comes up. You want to make sure that you approach them early enough and recognize that there may be certain trades. You need to trade a few horses to get that deal done. Okay, so let's dive into it. So in an asset deal, the employees of the corporation are terminated as of closing. Because what that means is when you close the deal and you buy the assets of that business and you move it into Purchase Co., the existing operating company, ABC Inc., still stays on. And so the current employment contracts and relationships between the employees and the business are with ABC Inc., even though the business assets have been moved into the Purchase Co. So what ends up happening is that the ABC Inc. severs the relationship with the employee, i.e. terminates them, and then Purchase Co. rehires the employees under the new company. So really that, from a transition and legal point of view, is a lot for an employee to understand. So there's a lot of education and explaining there. And then as well for key staff, it triggers the discussion of potential delayed gratification around raises, bonuses, promises in the past, and the smart employees are going to realize that they actually have leverage in the situation. So it's important to really understand that. But when you terminate the employees, the key question is, who assumes the severance? Because when you terminate in Canada, there's a severance liability with that termination. Well, in most transactions, the buyer assumes the severance obligations, thereby avoiding any payout of severance. Because really what they're doing is, I'll rehire you under the new corporation. I won't pay your severance, but I'll honor your seniority because it will continue on in the new company. Now, certain buyers who maybe want to carve out those liabilities will say, well, you know what? I don't want to assume the ongoing seniority of those employees. Therefore, the employees have to be trued up to the date of closing and receive severance up to the date of closing and then sign on under the new company at zero seniority. Now, who pays that if that's the case? Well, if the buyer is resisting paying that and the seller has to pay that, great, then the seller will pay that. But then the associated cost with that needs to be included in the purchase price. So usually for us, the comment that we say to buyers is, why would the seller pay their own severance when they're selling the business to you? Either you pay for the employees that are generating the revenues, that are generating the EBITDA that you're paying a multiple of, or we take the employees away, you don't generate the same EBITDA, and therefore the value goes down. So really, if you want to pay for the value of the business, you also need to assume the employees. You can't have your cake and eat it too. So I would say in most instances, buyers get that and they come around to that and realize, hey, listen, these asset deals, it comes with the nature of, if you're going to buy the employees, you're going to continue on their seniority. And it's no different in share deals. In share deals, you buy the shares of the business and there's no trigger of termination. The seniority just continues on. So it's no different than a share deal. You just want the step up in value of the asset deal. So then you're going to just have to continue the seniority on. Now, it's really critical when you rehire the employees that you offer similar employment terms. So you can't rehire someone at 10% less of their salary, or not offer them bonus, or not offer them benefits, because in Canada, if you do that and you try to change the employment terms, that can be seen as a constructive dismissal in the employment courts, and therefore that will trigger a severance payment. Even though maybe you want to honor their seniority, you can say, I want to honor your seniority, but I want to give you a lower salary. You're essentially dismissing them in the eyes of the court in Canada. So really, and because we operate in Ontario, Canada, for any tenured employees, it's really important that you offer similar employment terms, because if you trigger the constructive dismissal, then they are entitled up to 24 months of severance payment, of 24 months of salary. So that can be a substantial amount. And especially if the employee has no employment contract today, then they are fully able to maximize the severance payment, which the courts limit up to amount of 24 months. Now, if they have, for example, an employment contract, then it's really 1 week for every year of employment. But if there's no employment contract, then really they're going to get the full pop of 24 months right away. So just recognize that it's important as the buyer that you actually offer similar employment terms. Now, say for example, you don't want to offer you actually want to change the employment terms a little bit. What you can do is you can actually do a signing bonus. So maybe, say for example, there's really generous benefits and you want to claw some of those back. Now, and this is a negotiation, but you could go to the employees and say, you know what, we're going to give you less favorable benefits, but in lieu of that, we're actually going to compensate you upfront. If you sign this agreement, we're going to give you $10,000 right now to compensate you for that. Now, it depends on like a smart employee is going to weigh that and weigh their options. But if you pay for that, you can change it so long as the employee is okay with accepting whatever value you're going to give them. But if you just give them a take it or leave it offer and it's already reduced, then they can just say, no, I'm not going to take that offer. You're not giving me anything. You're essentially dismissing me. And so I'm going to sue you in court. Now, one consideration for you as the buyer is when you actually go through this process in the purchase and sale agreement, or in the an asset purchase agreement, there'll be a transition window in which you will extend employment terms at closing to all employees. Now, within those first 30 days, usually, or maybe week or 2 weeks or 3 weeks or 4 weeks, if there are any bad apples where the seller didn't disclose that to you, maybe there was unruly employees, people that are rejecting the sale and essentially resisting from signing on or not really delivering at the performance that was expected, what you would want to do as the buyer is just to say, hey, listen, I have at least 30 days to decide whether I'm going to terminate those guys or not. Because if they're unruly and they're bad apples, they're not really adding value to the business. And I don't want to take bad employees on. And this really prevents sellers from trying to, hide problems, because certain sellers may say, oh, you know what, like all my employees really are excited for this new deal, blah, blah, blah. And maybe they have 2 or 3 employees that have already been on their target firing list, but they don't want to trigger the severance because they know they're going to sell. So what this gives you is the opportunity for the first 30 days to assess those employees and determine if there's anyone that's bad that, maybe the seller hid from you, and trigger the termination. And so that cost now gets either shared or fully pushed onto the seller. So really, I recommend that when you are putting together your asset purchase agreement, you have some language there around the transition window. In the last deal that we did, it was a 30-day transition window. And because the deal was complex and the employees were there was a lot of holdouts and, there's a lot of stress around the employee transition. The buyer really pushed for 100% severance coverage in that transition window, meaning if if any employees were resisting the sale and either signed on but then they were just bad, they could trigger termination the first 30 days and the seller would cover 100% of the severance cost. Now, in other cases where maybe it's a little bit more competitive, there's an auction, multiple buyers are vying for that business, we as the sell side advisor may try to find a middle ground and have it and do a 50% cost coverage during that transition period. So it all depends on the dynamics of the deal. But the last point here is, say, for example, in the situation where you do extend an employment contract at similar terms to that employee, if that employee chooses to reject that and say, you know what, I'm done. I don't want to work for you. I only really wanted to work for the seller. I was thinking of retiring anyways. I'm not going to sign on. Well, in that situation, the advantage for you as the buyer is that they're essentially walking away from a substantially similar offer. And if they don't choose to sign on, then they're forfeiting their severance rights. So really that's the stick to the carrot. So the stick is, if these guys resist actually signing on, they're giving up maybe years worth of severance, which is a lot of money on the table, versus signing on and making it work with you. So it's not like they can play hardball all the way through, because the stick in your case as the business buyer is that if they don't sign on, they lose their severance. So they should sign on. So here are the big questions. The first one, and the obvious one, is when do you actually sign on employees? And it depends. The way I tier it out is that for key staff, it should be done pre-close in a couple weeks in advance, just to give them time to react and expect some sort of negotiation and expect some sort of back and forth there. If you kind of shotgun barrel them, they're the key staff. You're trying to build a relationship with them as the business buyer. You don't want to kind of put them over the barrel and force them to make a decision within 24 hours, because that's not a really good way to start a relationship. So usually you bring them into the fold a little earlier. And that's the challenge with an asset deal. From a transition and logistical point of view, now you have to advance the sale and letting them know that the business is for sale a little bit earlier than maybe in a share deal. In a share deal, you can close with the key staff not knowing until the day of. But in an asset deal, it's quite complex to do that, because really, there's going to be negotiation there, and maybe you're going to ask them to sign on for a multi-year agreement, maybe have update their employment terms. They may not have any employment agreement today, and you want them to sign an employment agreement. Therefore, they need to retain a lawyer and react to that. So you need to give them enough time. Now, on the flip side, for general staff, production staff, drivers, whatever the case is, usually what we see is that on the day of closing, there's the seller that announces that the business is sold. So they bring them all into the warehouse or bring them all into the office and say, ladies and gentlemen, this is what we've done. We've sold the business. These are the new buyers. I can vouch for them. They're fabulous people. And then, the next comment is, here are the updated employment contracts. And essentially, it's a one-page document that summarizes really and just confirming the following. And so you can see here, this is really language that I took from a past deal, where and it doesn't have to be complex. It's not like it's a multi-page agreement. It can be just one page that has the employee's name. It confirms that the business is being from Finance Kid Inc. is now being changed to Finance Kid Corp. And then this term right over here, we are delighted to offer you continued employment with ABC Corp in connection with the anticipated asset acquisition of the old ABC Corp. Your position, responsibilities, compensation, benefits will remain unchanged in accordance with your current employment agreement. We also confirm that your seniority accrued during your tenure with the old company will be recognized and maintained with the new company. So you've confirmed there's no change to your employment. We are honoring your severance and your seniority. So no change to your severance obligations as well. All you have to do is just sign this agreement and acknowledge that the company has changed over. So for general staff, usually there's not a lot of holdouts. They're working there. So the seller will just give them that document the day of the announcement, and I'll have them sign it. And that's it. So now the challenge, and moving to the next point, is there could be unforeseen delays or negotiations, and it usually comes from key staff. So the key staff recognize that they're key to the business. And here's the seller selling the business, realizing their pot of gold, and what about us? And there are some vengeful key employees that sometimes come out of the blue, and there's other key employees that they just don't care and they're happy for the seller. they'll sign whatever they have to sign just to make sure that the guy's looked after. So it depends on the situation, but what ends up happening is that the key employee may say, "Hey, listen, I've been holding out for a wage increase or a bonus increase, and the seller has been telling me for a couple of years now he's going to give it to me. Now I feel uncertain because I'm starting a relationship with you new, and now what? You're going to hold out on me for a couple of years as well? Like I was expecting to raise, come December, and it's October now." So there's all these mid conversations that have already happened, and you as the buyer come right into the middle of it. And so the key staff look at that and say, "Ooh, that's uncertain. I don't want to just start the clock from zero and have to earn your respect to then earn that raise when I was already almost promised that, or it was going to come down the pipe." So that's a very common situation where the key staff will come back and say, "Hey, listen, can we just get confirmation that that wage increase is going to come, whether it kicks in now on closing or it kicks in at December, and you just put that in writing there." So we've seen that often. And sometimes what ends up happening is to really grease the wheels. And some sellers will just actually share some of the sale proceeds with the key staff to get them to sign on. So it's really a closing signing bonus where it could be, for general staff, and I've seen this. So kind of talking again about the two different groups. For key staff, it could be a month worth of salary up to 12 months worth of salary. Like I've seen a full year of salary paid, whether it's on the closing date or spread out. So it's, half is paid now and then half is paid 12 month on the 12-month anniversary of the transition period. And for general staff, when you actually do the announcement and you hand out the letters for them to sign, you also say, "Oh, and by the way, once you sign these letters, you're also going to receive a small gift from us, just recognizing your loyalty to the company." And so we've seen $500 gift cards, $1,000 check giving to each staff. And so it's more distributed to everyone who signs on. And really, it's both a gratuitous thing for the seller to do to recognize the staff that have helped them build the business, but at the same time, it's grease on the wheels to make sure that people sign on to the deal. So it all depends. This is really, I think, the biggest pain for me as a sell-side advisor is navigating the employee discussion pre-deal, because it can really change. And a lot of people they get a little bit aggressive in these situations. So it's really important to start this discussion early, and then as well work hand in hand with the seller as the buyer, and be patient with the situation. Don't react right away, because I've seen certain situations where the employees come in and they ask for a ton, and the buyer gets really, really aggressive with them. Well, you're compromising your relationship from day one. It's better for you to just stay out of it. Let the seller sort it out. Let the seller be the bad guy, but you're behind the scenes pushing the narrative, pushing the agenda, and still working with the seller. But, it's almost kind of like negotiating with a union. You need a middle person. You need kind of like a middle manager. Well, here you're trying to negotiate with your new employees that you're going to work with. It's better for you to have the seller negotiate on your behalf than you coming in and wielding the hammer, because then that compromises your relationship. So again, something to think about there. And then the last point around employees, and this is actually more relevant for both Canada and the U.S., is one of the forgotten liabilities, vacation liabilities. So who assumes that? Say for example, it's an older company, it's a lean team, staff don't take vacation, haven't taken vacation in years. Well, now there's all this accrued vacation that most likely the seller hasn't accrued for on the balance sheet either, and you just don't know. So really, from a due diligence point of view, when you're closing on the deal, it's important to actually kind of go through the staffing list and actually see how many weeks of vacation each staff member have, how many have they taken in the last 2 years, to get an assessment of what the unpaid vacation liability is. Sometimes that's available in their payroll systems or their accounting systems or at ADP, but other times maybe they don't have the systems to track that. So it's just important for you to kind of know what that liability is, and then as well, who pays for that. So sometimes what ends up happening is that, again, on a share deal, you're just going to assume the vacation liabilities anyways because you're stepping into the seller's shoes. But in an asset deal, do you carve that out and ask the seller to pay that out and then set the vacation liability back to zero? Or do you step into that and then start encouraging staff to take more vacation moving forward as you maybe hire people, add technology, and reduce the workload on that staff, so that that liability starts to erode slowly? And the reason why it would erode slowly is that usually, and this is more relevant for Canada, in Canada, an employee is entitled up to 2 years of maximum vacation liability. So that's the max. So really, even though that employee may have not taken 10 years worth of vacation and they're just a very loyal employee, at the end of the day, the liability caps out at 2 years. Now, the 2 years depends on a certain percentage based on the tenure of the employee. So in Ontario, again, now say, for example, that employee has been here for, maybe it was hired 3 years ago. Well, then they fall within the 1 to 4 year tenure category. So therefore, their annual vacation accrual is going to be 4% of their salary versus if that employee's been around for 5+ years, then it jumps up to 6%, and it doesn't go up higher than 6%. So say, for example, it's a 10-year employee that hasn't taken vacation in 10 years and makes $100,000 a year. Well, then it's 6% because they fall in the latter category, times 2 because the cap on the accrued vacation is only 2 years. So really that employee would be owed $12,000. That's real money for someone. And so now again, the question is, do you as the buyer step in and assume that outstanding unpaid vacation liability, or do you have the seller pay out all the vacation, set the clock down to 0? But if they have 30 in staff, that could become a $100,000 bill right there that sometimes they don't want to pay. So an option that we usually push on the sell side is that we say, hey, listen, at the end of the day, the seller hasn't done a good job of managing their staff's required vacation liability and encouraging staff to take time off. You don't have to force that. Maybe you do a holdback or a VTB, something to hold back for 12 months or 24 months and tie the vacation liability to that. And if the liabilities are actually triggered where an employee asks to be paid out because maybe you sever them or whatever, then you deduct it off of the VTB. And then on the flip side, if you start managing the employees and encouraging them to take time off, well, now the 2-year clock moves forward and therefore the liability starts to erode slowly and slowly. So from the buyer point of view, you can actually drive down your liability. If now all of a sudden for the next 2 years, you encourage them to take their full vacation for the next 2 years, the liability gets zeroed out. So again, there's different ways to navigate this, but this is another one that it's a real unpaid liability, and it's who's going to cover the cost of an asset deal. So moving to the third category, customers and suppliers. And this is another complex one, but at the end of the day, there's a lot of work here. My number one comment is, again, communication and making sure that you're on the same page around timelines with the seller. So with an asset deal, again, if that business has contracts, because if it doesn't have contracts, it's really fairly simple. You don't really have to notify any customers prior to sale. But say, for example, that business has a service or maintenance contract. It's an annual, maybe a 3-year term, whatever the case is. And in that contract, it says ABC Inc. Well, now you're going to buy ABC Inc.'s assets and put it into purchase code, which is ABC Ltd. So you have to change the contract name to the new company. And then also in certain contracts, there may also be a clause that indicates a change of control clause where the customer, maybe they're a key customer to you, and they want to be notified of any change in control. So really from a sell side point of view, we always get ahead of that in the due diligence period. We go through each customer contract, all the terms and conditions, and make sure which contracts have the change of control provision, which contracts don't. So that's something that you can do maybe 2 months ahead of the closing process. You don't have to wait all the way to the end, but you need to get ahead of that when you're starting to do your due diligence as the buyer to ask for all those customer contracts and read the terms and conditions and see which contracts need to be notified. For those, usually what ends up happening is that you would go through the seller. The seller would pick up the phone and notify the customer, hey, John, this is what's happening. I'm happy to say that I'm retiring. I found someone that's really capable for this business. They're buying the assets of the business, just letting you know that there's going to be a change in control. We expect to close. Don't give a specific date, because usually, if there's any kind of delay, now you have to re-notify the customer, or the customer is not going to see the deal close and start asking questions like, they didn't close on the date that they say they were going to close. Is something going on? Is something bad going on? So you don't want them to let their mind run. It's better to just be elusive and say, hey, we're targeting, the next couple of weeks to close. Just letting you know, I just want to make sure that we're signing this contract over and I have your consent. Can you send me an email or send me a letter, providing the consent to the change of control? And that's really all you need. And sometimes the key customers may say, hey, you know what, happy to do that, happy to run it through legal. Can I meet the guy or girl? Would love to kind of understand, who they are and what they do. And so, there may be a subsequent meeting pre-close with certain key customers that really want to meet that person. You don't have to do that for all customers, but key customers that know that they're key to your business, they probably are going to demand that the buyer and that key customer meet. So just recognize that you may need to actually dedicate an hour or two to go out and see a customer pre-close. Now, again, the assignment can be in the form of a letter or just an email confirming, so long as it's in writing and now you have proof that you've notified that customer that they can never come back and say, oh, we're terminating the contract because you didn't notify us. Well, here's proof that I did and that you confirmed it. Now, another thing is it doesn't have to be just a contract, like a 3-year contract for a service agreement. It could also be a purchase order. So I've seen certain situations where it's a standing PO or an open PO with a certain customer, or a master service agreement, an MSA, where there's no defined value or no defined term, but it's more of an open relationship, but it's contracted. There's some sort of wording confirming that, hey, we're going to come back to you and do X reorder with you. And so with those POs, either on the PO document for that year, the terms and conditions are there, or what ends up happening is maybe that PO is just one page, but then you go on the customer's website and you click on terms and conditions for POs. So sometimes you have to chase that a little bit. I'll give you a really good example. We sold a business where one of the key customers was a municipality, and they had a PO with this business for 10 years. So really it's a contract, but it's just a PO, and it's a one-page document confirming the value, confirming kind of just the date, and it's an annual recurring PO, but there's no terms and conditions. So at first we were like, okay, well, we don't have to notify them. But then one of the lawyers really kind of flagged, no, I know this customer, just go on their website. And we went on the website and we actually saw there was terms and conditions for all existing suppliers. So just sometimes it may not be on the actual agreement. It has to be on the website. Just get ahead of that. But in that situation, there was actually a term and condition notifying that if there is a change in control, that PO, with anyone that has a PO, then you have to notify them and get consent as well. So again, trigger that and make sure that you start that conversation. Now, I bolded this here because it's true. Usually, the bigger the customer and the more key the customer to that business, the longer the process takes. The small customers, the nimble ones, like they're quick. They're like, oh, great, perfect. Let's move on. Let's start business. Let's keep doing business. Versus the bigger guys, they have to run it through multiple layers, go through legal, get a document. Sometimes the publicly traded ones as well, they're not going to issue paper and confirming any type of acceptance until their in-house general counsel or legal counsel reviews it. So it has to pass multiple hands, which ultimately takes time. So I've seen 2 weeks approval process. I've seen 2-3 month approval process. Depends. We had one where, they had contracts with international companies in Japan and the UK, and that process took forever, and it delayed the deal by a couple of months because we were waiting, and the buyer decided to wait out and make sure that they had the consent in hand. So the last thing is, and this is a key question, is do you need the consent for every contracted customer? So say, for example, you have a business, you have 200 active accounts, 150 of them have some sort of PO or contract that does have a change in control. Now, really, is it practical for you as the buyer to go out to all those customers and notify them pre-close and go through that process and get the consent? It depends. I mean, it depends on how risk averse you are versus, if you're a little bit more kind of aggressive to say, let's just close this deal off, talk to the top customers that we know we can't lose, and then maybe the 1-2% a year sales type customers, we don't have to worry about them as much. So sometimes we've seen that where in a deal, a buyer will go to the top 15-20 customers on the contracted basis, talk to those, trigger those processes, and run that within the next 2 to 3 weeks pre to closing. And then maybe all the other contracts, they're like, you know what, we're comfortable enough to just close the deal and bank on the fact that they're not going to give us a hard time, because certain customers, they're not. It's not like something's going to change, because what you're trying to communicate to them is, and usually most customers are happy. Think about it. You can kind of position in this way to say, hey, listen, here's a retiring business owner who's old and gray and who hasn't really modernized the business. We're either a strategic buyer or we're a younger financial buyer or an investment group coming in to really put money into the business to scale the business, where it's an improvement in service, it's an improvement in reaction time and modernizing the business. That's a positive for you as the customer. So most customers don't see it as a bad thing because they're mature enough to deal with M&A and they see it across their suppliers. So sometimes you can just close without the consent, but it depends on the materiality of the customer and your risk appetite. Now, another area for the customer, for just customers and suppliers, is actually the certifications and the regulatory approvals that business needs to operate, to either supply those set of customers or to work with the government, whatever the case is. So really getting ahead of that, just realizing what are the business registrations of that business, what are the regulatory, any specific industry specific type, barriers to entry that, you need this certification to do this, and not everyone has it. You obviously don't want to lose that, and you want to go through the proper channels and protocols to transition that. And so I kind of picked two examples here. So in Canada, for example, if you are a defense-related supplier, you're supplying components to tanks or airplanes, aerospace, whatever the case is, for the Canadian government, the U.S. government, U.S. military, whatever the case is, there's a controlled goods status, which is really issued by the government, confirming that you are an approved supplier that can work with sensitive defense-related type activities. And so that is something that you have to trigger pre-close. And so in this situation, you can go on their website, pull up asset sale, controlled goods Canada, and they have on that website, they have a list of things that you have to fulfill. And it even says there, at least 32 days prior to closing, the registration process has to begin. You have to submit information on the deal, who are the parties buying the business, background checks, criminal record checks, et cetera, et cetera. All of these things, you should not wait the week before, because the risk is if you close on that deal, and now you started the new corporate entity the next week, and the control good status has not been transitioned, you run the risk of being audited, and you run the risk of the government actually giving you a hard time. So those are situations where, just recognizing what are the special certificates that you need to get ahead of, and when do you trigger them. Another one is the WSIB, which is a workplace organization within Ontario for a lot of manufacturers, service-based type businesses. Well, here, they ask you to submit the vendor purchase information, the list of assets, the value of the assets, a copy of the asset purchase agreement, and a transition plan, almost like a business plan. And they're going to really want to see that you're ahead of that. So again, that's work for you as the buyer, that you should plan that out probably 2-3 months, really in the first 30 days post LOI, to just start gathering some of those documents, putting together that transition plan, so that it all doesn't fall on you the last week or 2 weeks prior to closing. And then the last one is getting credit approval from suppliers. So maybe that business has a key supplier. That's 60% of the cost of goods of that business. Now, they are going to extend credit terms, whether the credit terms are net 30, net 45, net 60, net 90, whatever the case is. There are certain suppliers that are key, that have those credit terms, that it's important, similar to a key customer, that you should probably keep them in the loop. So even though maybe you don't have a contract that requires you to notify them of change of control, if they're key and they're giving you credit terms, having that conversation a week prior to closing to say, hey, listen, the business is selling. We just want to make sure that you're aware of it, that everything, there's business as usual, nothing is going to change. And here's the new buyer, and here's the personal net worth, here's their credit score, here's the viability. Because there are certain suppliers that have been burned in the past when an asset sale has happened, and the new buyer steps in and they're a poor operator and they drive down the business into the ground, and the supplier may lose inventory that they've sold to them and may have to write off accounts receivable from their point of view. So there are certain suppliers that may actually want to ask for a credit approval to make sure that they can extend credit terms to you. So again, this is more of a business case, and it depends on each situation. You don't have to do this for all suppliers, because that would be impractical. If you had 50 active suppliers and there's 2 key ones, maybe you do the 2 key ones and everyone else you just let go. And then, again, a good way to think about it is that if you're really key to that supplier, then they're probably really nervous when that business sells. So you need to kind of weigh the odds of, am I really a big customer to them, or am I just 0.001% of their business? Because then they're not going to give you a hard time at all, even maybe if they're big to you. But if you're big to them and you're 40% of their business, oh yeah, they're gonna really dig into that. So make sure that you trigger that conversation. And another way to do it is, and we've seen this in the past, is maybe there's key staff that are aware of the sale, or you've triggered that employee conversation, and as part of the sign-on to get the closing bonus, you tell them, hey, listen, we want to transition the supplier relationship. Can you go through the back channels and talk to your key contact there and just see if there is any issue in us either letting them know or not letting them know? So we've seen that in the past where, because again, like at that level, that key staff is maybe a manager in the business that's selling, and they're going to deal with the manager and their counterparty at the supplier, who's not the owner, who's not really the key decision maker. So they're really more just having a conversation and saying, hey, buddy, like, we're going through a transition here. Just kind of keep that under your hat. Is there anything that we should be aware of? Like, have you in the past required credit checks with the new owner? What's going to happen? And that person at the supplier side is going to be aware of that, hopefully, and at least give you some guidance to say, do you really need to trigger a notification now or not? So that's another way to approach that. So hopefully that gives you a good overview. I try to cover the first three buckets. I didn't want to go over an hour here, but really, as you can see, there's a lot of different moving parts, and it's important for you to kind of get ahead and plan out as the buyer the different timelines and understand what can you start work now on so that all of that doesn't fall on your plate on the last month pre-closing. And unfortunately, most of the more first-time business buyers that go through an asset deal, that last month is really painful for them, and you can see that they're struggling to stay on top of it. So hopefully this video at least gives you an overview of some areas where you can start just putting that on your vision board to really get ahead of. If you have any questions, please do comment below or just reach out. You can reach out over LinkedIn, go to my website, send me an email at financekid.com. And then as well, if you have any questions and you're a Canadian business buyer or seller looking to operate in the lower middle market, just so you know, we sell businesses, our kind of sweet spots, that $2 to $50 million enterprise range. So please do reach out. Happy to connect as well. Thank you guys and have a great day.